The world is drowning in debt, but almost nobody is asking the most important question. If every country owes money, who is it actually owed to? The United States owes tens of trillions. Europe owes trillions more. Japan, China, developing nations, corporations, households, everyone is in debt. And yet, when you zoom out far enough, something strange appears. The world does not owe money to some external force. It owes money to itself. That sounds impossible at first, but it is the core truth behind the modern financial system. Because the global debt system was never designed to be paid off. It was designed to continue forever. Most people understand debt only at the personal level. You borrow money, you repay it, the obligation disappears. If you fail to repay, there are consequences. But national debt follows completely different rules. Governments do not borrow with the expectation of repayment. They borrow with the expectation of rollover. Old debt is replaced with new debt. Interest is paid. The principal remains. This is not a failure of the system. This is how the system is meant to work. To understand why, you have to look at how modern debt began. Before the late 17th century, kings borrowed money directly from merchants or nobles. These loans were dangerous. If a war was lost or tax revenue collapsed, the king defaulted, creditors lost everything. Debt was unstable and humiliating for rulers. Borrowing had natural limits because trust was fragile. That changed with one decision that reshaped global finance forever. In 1694, England was at war and nearly bankrupt. The government needed money but could no longer convince lenders to take the risk. A group of financiers proposed something new. Instead of a loan that would be repaid, the government would issue debt that would never be retired. In return, lenders would receive guaranteed interest payments backed by taxes. The principal would exist permanently. To manage this arrangement, a new institution was created, a central bank. This was the birth of permanent national debt. That single idea changed everything. Debt was no longer a temporary emergency tool. It became a permanent feature of the state. As long as the government could collect taxes, it could service interest indefinitely. And as long as interest was paid, lenders were satisfied. They did not need their principal returned. Debt became an annuity, a long-term income stream. Power quietly shifted away from rulers and toward financial institutions. Over time, this system expanded beyond governments. Government bonds became more than promises. They became assets. They could be bought, sold, pledged, and reused. Banks held government debt and treated it as the safest form of money. Central banks gained the authority to purchase these bonds, creating new currency in the process. Money stopped being tied to gold or physical production. It became tied to debt. Here is the critical point most people never realize. When a government issues debt, it is not simply borrowing existing money. In many cases, new money is created as part of the transaction. The bond becomes the foundation for new currency. Debt and money become inseparable. This leads to a shocking conclusion. If government debt were ever fully repaid, the money supply would collapse. Paying off debt would destroy money. That would trigger deflation, economic contraction, and mass unemployment. Governments cannot eliminate debt without destroying the system that supports modern economies. This is why national debt moves in only one direction over the long term, up. Even governments that promise fiscal discipline never eliminate debt. At best, they slow its growth. They cannot stop issuing bonds because the financial system depends on them. Pension funds need them, insurance companies need them, banks need them, central banks need them. Government debt is the foundation asset of modern finance. Remove it, and the entire structure destabilizes. Interest payments reveal how the system quietly transfers wealth. Governments collect taxes from workers, consumers, and businesses. A portion of that money flows directly to bondholders as interest. These bondholders are usually financial institutions and wealthy investors. This transfer happens every year, automatically, without debate. It is legal, it is normalized, and it steadily moves wealth from the productive economy to the financial economy. When countries struggle to service debt, the system does not allow the debt to disappear. Instead, it is restructured. New loans replace old ones. Conditions are imposed. Spending is reduced. Assets are sold. Sovereignty shrinks. But the debt survives. Default is treated as a last resort because it threatens confidence in the entire system. And confidence is everything. Over time, debt becomes a tool of control. Countries that rely on borrowing must maintain market trust. Policy decisions begin to prioritize financial stability over social outcomes. Governments protect bond markets, even when it hurts citizens, because if confidence in debt breaks, trade freezes, currencies collapse, and economies stall. The system rewards loyalty to creditors, not to people. This is why global debt keeps reaching new records. Financial crises do not reduce debt, they increase it. Every shock is met with more borrowing, more stimulus, more bond issuance. The solution to too much debt is always more debt. It sounds irrational, but within this system, it is logical. Debt is the fuel that keeps money moving. Once you understand this, the illusion disappears. The debt system is not broken. It is working exactly as designed. It is not meant to end. It is meant to persist, expand, and concentrate power through interest, stability, and dependence. And the longer it runs, the harder it becomes to escape. This is only the foundation of the system. When people hear the words financial crisis, they think of failure, banks collapsing, markets crashing, governments losing control. But inside the debt system, crises play a very different role. They are not accidents, they are pressure valves. And more often than not, they make the system stronger, not weaker. Every major crisis follows the same sequence. During good times, debt grows quietly, credit is cheap, asset prices rise, confidence builds. Then stress appears, growth slows, interest rates rise, a weak sector breaks, panic spreads. And just when the system seems ready to reset, intervention arrives. Central banks step in. Governments borrow massive amounts. New money is created. Old debts are protected. Losses are absorbed. What looks like collapse from the outside is transformation on the inside. This is the most important detail. Crises do not destroy debt, they transfer it. When private banks fail, their losses do not vanish. They move to the public balance sheet. When corporations collapse, governments bail them out. When markets crash, central banks buy assets. Private risk becomes public obligation. Debt shifts upward, away from individual institutions and toward society as a whole. This pattern is easy to see in modern history. After the global financial crisis, governments did not reduce debt, they expanded it. Trillions were borrowed. Interest rates were pushed toward zero. Central banks flooded markets with liquidity. The result was not a reset. It was the largest debt expansion the world had ever seen. Why does this keep happening? Because the alternative is unacceptable. If debt were allowed to fully fail, banks would collapse, savings would disappear, trade would freeze, and unemployment would surge. Governments choose stability over reset every time. They preserve the system, even if it means deeper, long-term imbalance. This is where ownership of debt becomes critical. People often hear that government debt is owned by pension funds, central banks, or domestic investors. That sounds reassuring. It feels like we owe money to ourselves. But this hides a deeper truth. Control matters more than ownership. Financial institutions manage the assets. They collect the interest. They influence capital flows. Even when debt is technically linked to public savings, it is administered by a small financial elite. Interest payments flow upward. Decisions are made to protect confidence, not equality. Debt service becomes untouchable. Governments can cut social programs, they can delay infrastructure, they can reduce public services, but they cannot stop paying interest. That priority reshapes policy. Governments stop acting as problem solvers and become managers of financial stability. At the global level, the system becomes even more restrictive. Countries borrow in currencies they do not control. When crises hit, their currencies weaken, making debt harder to repay. They are forced into restructuring programs. These programs do not eliminate debt, they extend it. New loans replace old ones. Conditions are imposed. Sovereignty erodes. The debt remains. This reveals the core truth. Repayment was never the goal. If debts were repaid, the system would shrink. Banks would lose safe assets. Central banks would lose control tools. Governments would lose flexibility. Modern finance cannot function without a constantly expanding base of debt. Inflation plays a quiet role here. Moderate inflation reduces the real value of debt over time. It allows governments to manage obligations without defaults, but it also erodes purchasing power. Savers lose. Wages lag. The system protects balance sheets before people. What looks like dysfunction is actually coordination. Governments, banks, and central institutions are aligned around one priority: keep the debt system alive. Crises are absorbed. Pain is distributed unevenly. Stability is preserved at the top. Volatility is pushed downward. This is why the system feels impossible to escape. You cannot vote it away, Italy. You cannot pay it off. You cannot shut it down without severe consequences. Debt has become the foundation of modern money, modern power, and modern governance. The real question is not whether the debt system will collapse. It is who will pay when it bends again. History shows that debt systems rarely end with clean resets. They erode slowly through inflation, through currency dilution, through declining living standards, hidden behind nominal growth. The system survives, while life inside it becomes more fragile. You can already see the signs. More debt is required to maintain the same standard of living. Housing becomes unreachable. Savings lose value. People work more for less security. These are not temporary problems. The future is unlikely to bring a single dramatic collapse. It is more likely to bring fragmentation, more debt, more intervention, more control disguised as stability, digital systems that make money easier to track and harder to escape. The structure tightens, not loosens. Understanding this does not mean panic. It means clarity. Once you see that debt was designed to roll forever, not be repaid, you stop waiting for an ending. You start paying attention to how pressure shifts, who benefits, who absorbs the cost. Every generation inherits a system it did not choose. Ours is built on leverage, rollover, and belief. It will not disappear quietly. It will adapt until something stronger replaces it. When future historians look back, they will not say the debt system failed. They will say it worked exactly as designed. It preserved power, delayed consequences, and transferred risk away from those closest to control. If this helped you understand how the debt system really works, subscribe for more clear nonsense breakdowns of money, power, and the forces shaping the world.